Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from HPS Corporate Lending Fund, and believe me, this one's a doozy. You might need an economics degree to understand it, but don't worry, because we will simplify it for you. This filing is actually a correction of a previous filing due to a clerical error, and also includes their prospectus. We will take a look at what the fund invests in, what risks you should consider, and how the company plans to use the money they collect. First, this isn't just a new filing, it's a correction. It seems someone at HPS Corporate Lending Fund hit the wrong button and filed their last update under the wrong file number. Now they are correcting it so that people looking for it actually find it. HPS Corporate Lending Fund is a business development company, or BDC. This means they invest in smaller companies to help them grow. But what exactly are they selling? Let's scroll down to the prospectus. This document details the offering of up to $15 billion of their common shares, meaning the company has the rights to raise this amount. They are selling 4 different classes of shares, each with different fees attached. The goal of the fund is to generate income, but it comes with risks. One thing that should raise an eyebrow is the expenses. Investors will bear substantial fees and expenses in connection with their investment. Be sure to understand those fees before you invest. The company plans to start selling shares as soon as this registration statement becomes effective. The actual date depends on when the SEC gives its approval. Here's the deal. This filing is being made solely for the purpose of correcting the file number under which HPS Corporate Lending Fund previously filed post-effective Amendment No. 1. Investing always carries risk, and this report mentions a lot. Let's look at some of the biggest. First, the fund has limited operating history. The fund is fairly new and investors lack a track record to base their decisions on. Like any new business, there's no guarantee of success. Another major risk is liquidity. It may be difficult to sell your shares. There's no active market, so you might be stuck with your investment for an extended period, which may be bad if the company doesn't perform well. The fund focuses on securities rated below investment grade. These junk bonds carry a higher risk of default. That means the companies might not be able to repay the debt. The fund uses leverage or borrowed money to magnify returns. While leverage can boost profits, it also increases the potential for losses and may increase the risk of investing in the fund. The risks of investment in a highly leveraged fund include volatility and possible distribution restrictions. HPS sources its investments from a diversified network, including companies, management teams, banks, financial intermediaries, and financial sponsors. The report mentions something called multi-class exemptive relief. It is related to the 4 classes of shares that they are offering. It appears HPS touts its strength in 3 key areas that it says are diversified sourcing network, breadth of HPS's credit investment platform, and willingness to navigate complexity. Now let's scroll down to the part you really want to know about, the fees. It's good that they are showing this because this is real money out of your pocket and is not reflected in company performance. Maximum sales loads are 0%, but you might need to pay a little money if you sell before a year. However, if you buy Class S shares, Class D shares, Class I shares, or Class F shares through certain financial intermediaries, they may directly charge you transaction or other fees, including upfront placement fees or brokerage commissions. This is where it gets scary. All of the classes are paying very big fees. The total annual expenses range from 8.5% to 9.3% a year. That means a $10,000 investment in Class S shares would cost you $930 every year, not counting any potential incentive fees. Can with Class I shares, it would be $845 FCO. That is a lot of money. To try to help, there are some examples of the projected dollar amount of total expenses that would be incurred over various periods with respect to a hypothetical $1,000 investment in each class of our common shares. In plain language, with Class S shares, after 10 years, 76.9% would be gone, or $70.69 out of hand dollars. Class I still looks expensive, with 72.5% gone in fees after 10 years. Remember that the value of the investment itself is not factored. This calculation is based on 5% annual growth. Now we need to scroll further to see how the company has performed. It does seem they are overcharging compared to their gains. Check that out, what a big table. Let's look at some highlights so you don't glaze over this information. The total return based on NE is about 12 to 13% for all classes, which is pretty good. What is not good is the ratio of net expenses to average net assets. It ranged from 8.78% to 9.54% Hubst, X-Time to 9.54% Hubst. Pendcaker, those expenses are close to wiping out half of their returns. This seems like a pretty expensive way to invest. Let's scroll to look at some of those investment strategies and other important info. The fund's investment strategy primarily focuses on companies in the United States, but it also aims to leverage HPS's global presence to invest in companies in Europe, Australia, and other locations outside the US. These investments may include equipment financing, financing against assets, and mortgage loans. HPS believes that its main competitive strengths are that it has scaled capital, a diversified sourcing network, and a willingness to navigate complexity. The advisor shares investment opportunities with its other clients and HPS's other clients, and the fund generally be allocated to us, the advisor's other clients, and the HPS funds that target similar assets to prorative based on available capital in the asset class being allocated. So the report will go into effect immediately upon filing with the Securities and Exchange Commission. The fund is a business development company, which means it makes investments to help smaller companies grow. Now, what do I think about this company? It has some interesting strategies and access to some interesting deal flow, but the biggest problem seems to be the very large fees they charge. The management has to perform exceptionally well in order to actually make money for their customers, something that has not been apparent in their financials as of yet. The company is very opaque to read through, and it's high value investments, and while they present limited access to liquidation and share redemption requests, the lack of trading on an exchange makes it very difficult to obtain liquidity. Finally, it seems that a transaction is going through the BlackRock, and this is a big event that bears keeping an eye on to see what impact it has on the fund in the long term. All I can say is to make sure you do your homework. If this video was useful to you, please subscribe, like, and comment. It really helps to keep this channel going. Thanks for watching Corporate Decoder.